Goldman Sachs just shocked Wall Street by raising their gold price target to $5,400 per ounce, and they're saying the upside risks are significantly skewed even higher. Meanwhile, gold just smashed through $5,100, hitting fresh all-time highs as the world's wealthiest investors scramble to protect their wealth. What Goldman knows that most investors don't could be the difference between getting rich and getting left behind. Stay until the end, because what's happening right now has never occurred in financial history. Smash the like button, comment your thoughts, and subscribe for more silver content. On January 21st, 2026, Goldman Sachs dropped a bombshell that sent precious metals markets into overdrive. The investment banking giant raised its December 2026 gold price forecast to $5,400 per ounce, up more than 10% from their previous target of $4,900. But here's what should terrify anyone holding cash. Goldman explicitly stated that risks to this upgraded forecast are significantly skewed to the upside. Think about what that means. Goldman Sachs, one of the most conservative forecasters on Wall Street, is telling you their $5,400 target might be too low. When the smart money starts hedging their own forecast to the upside, you need to pay attention. Gold wasted no time validating Goldman's bullish call. Just days later, on Monday, January 26, spot gold prices surged 2.4%, trading at $5,102 per ounce before settling around $5,086. US gold futures for February rose 2.1%, reaching $5,087 per ounce. This isn't just another rally. Gold has climbed 17% already in 2026, extending a blistering performance that saw it jump 64% in 2025. We're witnessing the fastest wealth preservation scramble in modern financial history, and most people have no idea why it's happening. Goldman's analysts, including Dan Stroven and Lena Thomas, explain the catalyst behind their upgraded forecast in terms that should alarm every investor. They're betting that private investors who bought gold as a hedge against macro policy risks will maintain these positions through the end of the year. But here's the critical detail most people missed. These aren't short-term traders. These are long-term hedges against systemic risks that show no signs of resolving. Comment below whether you think Goldman's $5,400 target is conservative or aggressive. Do you see $6,000 this year? Unlike previous hedges tied to specific events like the November 2024 US election, positions taken against perceived risks such as fiscal sustainability may not fully resolve in 2026. Goldman calls these hedges stickier because the underlying concerns about government debt, central bank credibility, and policy uncertainty aren't going away. They're getting worse. The demand picture has fundamentally shifted. Western ETF holdings have climbed by around 500 tons since the start of 2025, far outpacing predictions based solely on US interest rate cuts. Global gold ETFs logged record inflows of nearly $89 billion in 2025, pushing holdings to all-time highs near 4,025 tons, according to the World Gold Council. December 2025 marked the 7th consecutive month of ETF inflows. That's not a momentum trade. That's a structural shift in how sophisticated investors view portfolio construction. When institutions start treating gold as a permanent allocation rather than a tactical position, it fundamentally changes the supply-demand dynamics. Central bank buying remains relentless. Goldman expects monetary authorities to purchase an average of 60 tons per month in 2026, with emerging market central banks likely continuing the structural diversification of their reserves into gold. These aren't price-sensitive buyers who back off when gold rallies. These are strategic accumulators building positions regardless of short-term price movements. Here's why that matters. When you have two massive buyer groups, central banks and private wealth, competing for a finite supply of physical gold, price becomes increasingly irrelevant to demand. The higher gold goes, the more it validates the thesis that fiat currencies are losing purchasing power, which drives even more buying. It's a self-reinforcing cycle that can push prices to levels that seem absurd until they're in the rearview mirror. The so-called debasement trade is accelerating at a pace that should terrify policymakers. High net worth families are making physical gold purchases as insurance against long-term monetary and fiscal policy trajectories in major economies. These aren't retail speculators chasing momentum. These are the people who move markets, and they're voting with their capital. Smash that like button if you think the debasement trade is just getting started, and subscribe for daily precious metals market updates. Goldman's research reveals something fascinating about investor behavior. As concerns mount over long-term policy trajectories, gold has been boosted by demand. That includes physical purchases by high net worth families and investor call option buying. The options market is particularly telling. When sophisticated traders start buying call options at strikes well above current prices, they're positioning for explosive moves higher, not just defending current levels. The geopolitical backdrop continues to deteriorate on multiple fronts. Since the start of 2026, friction between the US and NATO over Greenland has escalated tensions with traditional allies. President Trump's decision to back away from tariff threats tied to Greenland provided temporary relief, but EU leaders warned they remain ready to respond if similar pressures re-emerge. Venezuela has become another flashpoint. US strikes on Venezuelan targets sent metals prices leaping higher as investors questioned whether military interventions could become more frequent. Trump's threats against the Iranian regime after a widespread crackdown on protesters added another layer of uncertainty. Each geopolitical escalation reinforces gold's role as the ultimate safe haven. The Federal Reserve situation has created unprecedented institutional uncertainty. Despite muted stock market reactions, metals got a massive boost after Fed Chair Jerome Powell announced he is the subject of a criminal investigation. The implications are staggering. If the Fed loses its political independence, it could benefit stocks short-term by sending interest rates lower, but it would devastate the central bank's credibility long-term and potentially reignite inflation. Think about the impossible position the next Fed chair will face. On Monday, President Trump threatened to raise tariffs on autos, lumber, and pharmaceutical drugs from South Korea, with duties on other goods increasing from 15% to 25%. These tariff threats are driving industrial metal prices higher across the board, creating serious inflation pressure. Tin, copper, aluminum, lithium, and zinc prices are all surging in 2026. Peter Bukvar, an independent analyst, warned that we have serious industrial metal inflation happening, and the next Fed chair will face quite the dilemma. How do you fight inflation with interest rates when the administration is actively pursuing policies that drive prices higher through tariffs? The answer is, you can't, which means the Fed will face mounting pressure to keep rates low despite rising inflation, undermining confidence in fiat currencies, and driving even more capital into hard assets like gold and silver. Drop a comment with your thoughts on Fed independence and whether you think Powell will survive as chair through 2026. Goldman's forecast incorporates expectations of 50 basis points of additional Fed easing in 2026. Markets are pricing in 2 rate cuts in the second half of the year, despite inflation concerns. Lower interest rates reduce the opportunity cost of holding non-yielding assets like gold, making the metal more attractive relative to bonds and savings accounts. But here's where Goldman's analysis gets really interesting. They assume that hedges against global macro policy risks remain stable because these perceived risks around fiscal sustainability may not fully resolve in 2026. Translation: the government debt problem is unfixable in the near term, and smart money knows it. BlackRock CEO Larry Fink has been sounding the alarm about the ballooning national debt that's now over $38 trillion. The Congressional Budget Office projects deficits will continue growing as a percentage of GDP for the foreseeable future. No serious fiscal reform is on the horizon. The political will to address spending simply doesn't exist. When sovereign debt reaches levels where markets start questioning sustainability, precious metals become the obvious refuge. You can't print gold. You can't devalue it through policy decisions. It exists outside the financial system as the ultimate form of money that no government can manipulate, the AI investment wave adds another dimension to this story. Goldman Sachs' own research warned that AI capital expenditures could reach a whopping $1 trillion in coming years, even as monetization is still catching up. Microsoft CEO Satya Nadella said that to prevent an AI bubble from forming, benefits need to be broadly shared rather than confined to the tech industry. The stock market concentration is extreme. The Magnificent Seven made up about 37% of the S&P 500 as of late October 2025. The S&P 500 is trading at over 22 times forward earnings compared to a 20-year average of 16.1 times. When valuations reach these levels and concentration is this extreme, diversification into uncorrelated assets like gold becomes essential risk management. Gold's performance relative to stocks tells you everything you need to know about what sophisticated investors fear. While the S&P 500 has delivered solid returns, gold has absolutely crushed equity performance over the past year. A 70% gain in gold versus mid-teens equity returns represents a dramatic repricing of risk. Union Bancaire Privé analysts stated that gold should enjoy another strong year, reflecting ongoing central bank and retail investment demand, with a year-end target price of $5,200 per ounce. Note that even UBP's target is below Goldman's, and Goldman says risks are skewed to the upside. The consensus among major banks is shifting dramatically higher. Smash the like button, comment your price predictions, and subscribe for more precious metals coverage. Make sure to hit that notification bell. The physical gold market is showing signs of strain. HSBC noted that recent price action has been driven by geoeconomics issues related to Greenland and other flashpoints. But beyond geopolitics, the simple reality is that physical gold cannot be created to meet surging demand. Mining production is relatively fixed in the short term, and years of underinvestment mean new supply won't come online quickly. When ETFs need to buy 500 tons in a few months, that physical metal has to come from somewhere. Either existing holders sell, or prices rise high enough to incentivize selling. Given that central banks and high net worth families are strategic buyers, not sellers, the burden falls entirely on price-sensitive holders, and there aren't enough of them to satisfy this level of demand at current prices. Silver rallied right alongside gold on Monday, with spot prices jumping 4.9% to $107.90 per ounce, also benefiting from industrial demand. The gold-silver dynamics are fascinating. Gold is pulling silver higher through monetary demand, while silver's industrial applications in AI chips, solar panels, and batteries provide an independent bullish catalyst. Platinum hit a record high of $2,749.20 per ounce and was last up 4%. HSBC expects a structural deficit in platinum to widen to 1.2 million ounces this year. When precious metals move in unison like this, it signals broad-based loss of confidence in fiat currencies, not just temporary safe haven flows. The dollar's decline is accelerating the precious metals rally. The US dollar index dropped over 6% in 2025, its worst performance since 2017. When the world's reserve currency is weakening rapidly, international buyers find dollar-denominated commodities like gold cheaper, creating a feedback loop that drives prices higher. Looking ahead, multiple catalysts could drive gold toward Goldman's $5,400 target and beyond. Trump's infrastructure plans could boost deficit spending significantly. Trade wars could escalate if tariff threats materialize. The Fed's independence could erode further if political pressure intensifies. Any of these individually would support higher gold prices. Combined, they create conditions for an explosive move. Goldman's analysts wrote that risks to the upgraded forecast are significantly skewed to the upside because private sector investors may diversify further on lingering global policy uncertainty. Read that sentence again. Goldman is explicitly telling you they might be too conservative, even at $5,400. Comment below if you think we'll see $6,000 gold in 2026. What's your target? The bottom line is this: Goldman Sachs just raised its gold forecast to $5,400 with explicit warnings that risks are skewed higher. Gold is already trading above $5,100, validating the bullish thesis. Central banks, ETFs, and wealthy families are competing for finite supply with no signs of backing off. The structural drivers supporting higher prices, fiscal unsustainability, geopolitical instability, Fed independence concerns, inflation pressures, and dollar weakness are all intensifying. This isn't a bubble. This is a fundamental repricing of what constitutes safe assets in an increasingly unstable world. Whether you own gold or not, Goldman's forecast upgrade should serve as a wake-up call. The smart money is positioning for significantly higher prices. Central banks are accumulating at record rates. Wealthy families are making physical purchases in size. The time to pay attention is now, before $5,400 becomes the floor instead of the target. Don't forget to smash that like button, comment your thoughts on Goldman's forecast, and subscribe for more market coverage. This is the most important precious metals story of 2026, and you're witnessing history.